Good afternoon. Thanks everybody for tuning in today. We're happy to have you with us. I'm Nikki Vincent, the Executive Director of ACG Minnesota. And as we continue on with our virtual programs, we want you to know that you continue to be in our thoughts and our prayers, and we hope that you and yours are staying healthy and staying sane. There's a lot of things happening, and things are moving really, really quickly. So to that extent, we're trying to present on issues that are top of mind, that are trending, that people need to know about. And we just want to do a reminder to our membership that you can lean in on one another and lean in on us and reach out to the resources you have at your fingertips. To that extent, if there's any new members online with us today, we just want to say thank you for tuning in. We really look forward to welcoming you live in person, but until then, we're just happy to have you with us here today. For those of you who don't know who ACG Minnesota is, we're a networking organization, a global organization that's focused on driving growth in the middle market. We have almost 400 members here locally and about 15,000 globally, with a chapter in almost every state in the nation. We are a robust networking group that typically meets live in person, and unfortunately, this is how we're meeting now due to our circumstances. So again, thank you for joining us. Heads up to our members, every Thursday there's a 4:30 p.m. happy hour that's members only. It's a really fun. We did have trivia last week, and we're going to do that again this week. With that, we're going to be doing trivia for about the first 30 or 60 minutes, followed by some breakout sessions. So we've heard the young professionals want to have a place to go and talk. So we're going to have different breakouts. It could be a deal makers lounge. It could be the banker's corner. It could be the young professionals. If you have an idea or a thought on that or a room you'd like to see, let me know and we'll make sure that happens on Thursday. Also, as many of you have seen, businesses are changing and pivoting kind of their strategy. We're going to start focusing on a few members that have been pivoting their strategies, such as Woodchuck. They've gone from custom wood products to now making the PPE face shields. So we're going to be showing those on, or showcasing Woodchuck on this Friday, April 24th. And Georgie, I'd just like to say, can you advance the slides? Doesn't look like they're moving. Anyway, so Friday at 7:30 a.m., we're going to do a corporate breakfast starting with Woodchuck and just learning and listening to how they've changed their strategy. Thank you. There it is. You see that on the screen now. And then before we begin, I just want to do a huge shout out to all of our sponsors, our invaluable sponsors, and without whom we could not be putting on our programs virtually or live in person. So thank you to Boulay, to Bremer Bank, to CIBC, to DataSite, to Highland Bank, Lathrop GPM, Lurie, Oxbow, Quasar Capital Corporation, Redpath, Taft, TriNet, Winthrop and Weinstein, Allied Executives, and our media partner, Twin City Business Magazine. When you think about doing business, think about these folks. They're experts in their field, and we really love to collaborate with them and appreciate all of their support. Now, before we get started with the presentation, just a few logistics. Everybody should be muted and cameras off except for our presenters. It just helps cut down on some of the background distractions and noise. Throughout the event today, if you have a question, please put your question in the chat function, and we will be taking questions at the end of each presentation. If you don't have the chat capability or you don't see it, you can text your questions to 612-242-6800. This presentation, the audio clip, and the PowerPoints will be made available by the end of the day to everybody, as well as all of our past presentations. You can find those on the ACG Minnesota website. So with that, a big thank you to both Baker Tilly and Lathrop GPM for presenting today. And to introduce our speakers, I'm going to bring in my program chair, Craig Stiro, with Integrated Consulting Services. Craig, take it away. And you're on mute. Here we go.
Sorry. Okay. All right. Thank you. Thank you, everyone. Thanks for attending our Lunch and Learn today. We're looking forward to, again, presenting some valuable information to all of you relative to this new environment for which we live in. So I'd like to introduce our speakers. First from a tax partner, Jackie Lee, a tax partner at Baker Tilly. She's on the manufacturing and distribution industry team, focusing on the life science niche. Her practice focuses on corporate tax compliance and planning for small to mid-sized organizations. Interesting note, she has not left her house in 5 weeks, literally not once. So thank you, Jackie. The other speakers are from Lathrop GPM. And first I'd like to introduce you to Alexandra Rowe. She is a partner at Lathrop GPM's insurance recovery practice. She represents policyholders in all aspects of insurance recovery. She is currently broadcasting from her home in Los Angeles, California. And lastly, Mark Williamson is also a partner at Lathrop GPM, and he's the chair of the firm's business transactions practice group. He's been sheltering in place in his office on Deer Lake in Grand Rapids, Minnesota, with his family. We thank for all the speakers, and we'll start with Jackie. Thank you.
Great, thanks, Craig. Good afternoon, everybody, and thanks for joining us today. Today, I'm going to be focused mainly on the tax provisions included in the CARES Act. With an estimated price tag of over $2 trillion, the CARES Act is the largest, most expensive bill that has ever passed in the history of the country. In an effort to offset the COVID-19 economic impact to the country, the Act does include a variety of items. Built into this package are changes to the 2017 TCJA intended to temporarily lower companies' tax bills, as well as provide opportunities for current refunds. Prior to the well-known CARES Act was the Families First Coronavirus Response Act. Many in Congress, excuse me, I had a little computer glitch there. Many in Congress have been engaging in talks about another stimulus package. Some have wanted to wait and see how the first package plays out, and others in Congress wanted to kind of hurry up and issue another relief package. Ideas that have been floating around include a removal of the $10,000 SALT cap, a payroll tax cut, an infrastructure plan, capital gain rate cut, among other ideas. The latest news is that the House, Senate, and White House are close to finalizing another $450 billion piece of legislation. What may drive this legislation is that the Paycheck Protection Program, or PPP loan program included in the CARES Act, has already exhausted its initial funding. Small businesses were supposed to be able to apply funds in this program through the end of June. On April 16th, the initial appropriation was fully utilized. So in less than 2 weeks, the $350 billion was exhausted. So the most popular lending programs made available as part of the various COVID-19 legislation have been mainly focused on small businesses with less than 500 employees. The EIDL program allows for a loan of up to $2 million, collateral is required, and you need to provide cash flow projections as well as demonstrate a need. The Paycheck Protection Program has truly been the darling of the lending programs, offering a potential forgiveness of 100% of the loan if certain requirements are met. This program was met with more questions than answers initially. And there are a couple of items I would like to mention about the PPP program. As I mentioned earlier, the legislation currently being negotiated may provide an additional $300 billion of available loans under the PPP program. I tell folks to pay attention to the 500 employee headcount limit, as there are organizations with certain NAICS codes that may qualify even if they have more than 500 people. In addition, In some cases, there are revenue thresholds that apply versus the head count. So it's important to make sure you understand all the details of the program. I would seek assistance when determining the loan amount that your business might qualify for, and then what amount of that loan might be forgiven at the end of the 8-week period. There are certain rules that you need to follow in order for the loan to be forgiven. For example, you need to spend about 75% of the loan proceeds on wages. And there's also a head count calculation. So there are some requirements in order for the loan to be forgiven. Okay, so we've all heard a lot about the PPP program and how it's helped small businesses. However, we've also heard about the punitive affiliation rules and how many private equity-owned portfolio companies have been able to take advantage of this program. So what about a business that doesn't qualify as a small business? Both the EIDL and PPP loan programs have not been very friendly to these types of businesses. I would like to discuss a loan program earmarked specifically for mid-sized businesses under the Emergency Relief and Taxpayer Protection section of the CARES Act. However, there are conditions that management and owners of eligible businesses should be aware of before diving into the program. And unlike the Paycheck Protection Program loans, these cannot be reduced through forgiveness, but they are also not subject to the affiliation rules. So the program I'm going to touch on is called the Main Street Business Lending Program, and it offers 2 tranches of available loans. There's new loan facilities and expanded loan facilities. So funds were appropriated by the CARES Act in a single common special purpose vehicle intended to facilitate lending to small and medium-sized businesses. The SPV participates 95% and lenders participate at 5%. So who's eligible for these programs? Businesses up to 10,000 employees or up to $2.5 billion in 2019 annual revenue. Please note that this is an or condition. So for example, a borrower may have more than 10,000 employees and revenues under the 2.5 billion, but they would still qualify, and vice versa. The eligible borrower must be a business created or organized in the US with significant operations and the majority of its employees based here in the US. So what are the loans and, what are the loan terms and conditions? So it needs to be a new eligible loan originated on or after April 8th of this year, or an expanded term loan originated before April 8th of this year. These loans have a 4-year maturity and the SOFR rate plus 2.5% to 4% is applied. So the minimum loan amount is $1 million, and there are specific rules that apply to the maximum loan amount. Keep in mind that the borrower does need to make certain attestations surrounding limitations on using the proceeds to repay, refinance, or cancel pre-existing loans or lines of credit. The borrower must attest that it requires financing due to the circumstances presented by COVID-19 pandemic and use the proceeds to make reasonable efforts to maintain its payroll and retain its employees during the term of the loan. In addition, the borrower must attest to follow compensation, stock repurchase, and capital distribution restrictions as defined in the applicable section of the CARES Act. The specific process has yet to be announced and the application form has yet to be released. Okay, so let's dive into the actual tax provisions that were included in the CARES Act. I'm going to start today on the business side, and I'd like to start by talking about net operating losses. And note that the CARES Act has restored pre-TCJA NOL rules. So what that means is that NOLs can offset 100% of taxable income for 2018 through 2020. The 80% limit that was established by TCJA will be restored starting in 2021. The CARES Act also is allowing for a 5-year carryback period for NOLs from 2018 to 2020. Note that AMT rules may still be in effect depending on the carryback year. So taxpayers should consider amending tax returns and filing carryback claims to obtain refunds if they qualified to do so. Generally, also note that generally the time frame to make a carryback claim is 12 months after the end of the taxable year in which the NOL arose. The IRS has extended this deadline an additional 6 months. So for taxpayers with 2018 NOLs, they do have until June 30th to file a claim. It's important to discuss with your tax advisor the best way to claim the refund, either through an application for tentative refund or by amending your corporate income tax return, as there can be a difference in the exposure of uncertain tax positions in closed years depending on the method chosen. Okay, moving on to loss limitations for non-corporate taxpayers. Starting in January of 2018, TCJA did limit excess business losses from non-corporate taxpayers. So that meant that losses flowing through from S corporations and partnerships could only offset non-business income with a portion of the loss plus a threshold amount as indicated. The CARES Act has effectively delayed this provision until 2021. 163J business interest expense limitation. We've probably all heard about this. It came about as part of TCJA. And what's happened as part of the CARES Act is that the limitation has increased from 30% to 50% of the taxpayer's adjusted taxable income. And that applies to 2019 and 2020. However, do note that for partnerships, they are not able to take advantage of this increased limitation until 2020. There's also a special election that allows the taxpayer to use its 2019 ATI in lieu of its 2020 ATI. And this election is made by the partnership and affects all partners. In short, the rules around 163J for partnerships are going to be very complex in 2020. Okay, qualified improvement property. This is long-awaited relief for the drafting error that occurred as part of TCJA, where qualified improvement property was not eligible for bonus depreciation. Although Congress intended for it to be bonus eligible, it didn't specifically include a 15-year recovery period for QIP, and thus it ended up being considered non-residential retail property with a recovery period of 39 years, thus making it not eligible for bonus. So as part of the CARES Act, this retail glitch has now been fixed, which many people are very happy about. So for taxpayers that placed QIP in service in 2018, they may be able to file an accounting method change with their 19 return to catch up on the bonus depreciation or file an amended 18 return. However, if taxpayers have already filed their 19 return, the accounting method has been established and they can only correct it through a method change. Okay, this slide outlines a few more items that were included as part of the CARES Act. So there's a payroll tax deferral, and what this allows organizations to do is to defer the FICA portion of the employer payroll tax and deferring it out so that 50% is payable in December of 2021 and the other 50% is payable in December of 2022. There's also, one note on the payroll tax deferral I did want to make is that it was recently clarified that organizations that are taking advantage of the PPP program are allowed to use that deferral during the 8-week testing period. So basically, they can use this payroll tax deferral up until the date their loan is potentially forgiven. There's also an employee retention credit that's available, and it provides a quarterly credit against certain employer payroll taxes that are available for employers that have experienced full or partial suspension in operations. Note that it is somewhat of a complex, multifaceted calculation, and I would recommend you consult with someone to make sure you fully understand how the credit works and how the various factors are going to impact the credit that's available to you. I know Baker Tilly has a calculator that we're helping clients use to assist with figuring out the amount of the credit. The CARES Act also provided for emergency sick leave pay and emergency FMLA pay, and those credits were made refundable. Another item in the CARES Act is that unused corporate AMT refunds are now refundable in 2018 and 2019 versus the longer refundable period that was established by TCJA. Okay, so that ends the business provisions that were included in the CARES Act, and now I'm going to turn to discuss some of the individual provisions that were included. So as most people know by now, there are rebates that are being sent out to folks, $1,200 per individual and $500 per dependent child. The phase out starts at $150,000 of joint AGI, and that completely phases out at $198,000 of joint AGI. There's also a provision that allows taxpayers that are taking the standard deduction on their tax return to be able to deduct up to $300 of cash charitable contribution payments that were made in 2020. So normally, if you don't itemize your deductions, there's no additional deductions available for contributions, but in this case, they're making an allowance for up to $300. In addition to that item, in 2020, taxpayers are also allowed to make cash contributions to qualified charities up to 100% of AGI. Another item included is that there's a temporary waiver of required minimum distributions from certain retirement plans and IRAs for amounts required to be distributed in 2020. So as you can see, there's a lot here for taxpayers to consider as they think about their tax planning over 2020. So even if you don't need the cash from your RMD, folks might, consider things like tax rates. And we all know taxes are at a low right now. And so there's only one direction for those to go. So even though the deferral is allowed, folks might decide to take the distribution if they feel like taxes could potentially go up in the future. Another item for individuals to give some thought to is perhaps an in-kind distribution from their IRA or retirement account and put that into a taxable investment account. That current value is taxed and your holding period resets, but this can be useful in certain situations. And one of those situations is when the market is down. So sometimes folks don't like the idea of selling their investments when the market is low. And this is a way that you can keep your assets intact. Also, sometimes there's just a stock that people have a particular fondness for and they think it might do better in the future. And so they don't necessarily want to sell it. So again, this in-kind distribution allows you to keep that stock. And lastly, as mentioned before, if you don't need the cash now, taking the in-kind distribution allows you to move assets and potentially get favorable long-term capital gains treatment down the road. So the last item I'm going to touch on with regards to the CARES Act is the fact that it did ease restrictions on early withdrawals from retirement plans. So the 10% early withdrawal penalty we all know about is waived, and taxpayers may pay taxes on early withdrawals over a 3-year period or elect to defer entirely for up to 3 years. And this applies to a maximum withdrawal of $100,000 of a coronavirus-related distribution. Another item that was included is that taxpayers are able to take a loan from their account, and that can be the lesser of $100,000 or 100% of the account balance. So keep in mind that taxpayers need to be affected by COVID-19, meaning diagnosed with the virus, or a spouse or dependent is diagnosed with the virus, or you've experienced adverse financial consequences. So this wraps up my portion of the presentation today. As you can see, the CARES Act brought with it A lot of changes in the tax arena. And as always, I encourage you to consult with your tax advisors and make sure you're taking advantage of all the benefits that are available to you. And more importantly, make sure you understand the impact to you and your business. I know many of you out there know Will Roach, and so please feel free to reach out to Will or myself. Thanks so much.
Good morning. I don't know if you can hear me. My name is Alex Roget, and along with my partner, Mark Williamson, we're here to talk about insurance coverage for coronavirus losses. Presumably, many of you have suffered some sort of loss. I mean, everyone that operates a business in this country right now has likely been affected. And the purpose of the presentation today is to just go through the various types of coverage that might be available for your business, and to talk about the various issues that have arisen. And if you have any questions following the presentation, we are of course available to answer questions if we have time at the end, but also feel free to just let us know through ACG, or you can contact us directly and we will do our best to answer all your questions.
Alex, I would like to just add a couple of thoughts here before we get into the details. But in talking to clients and people looking at various options during this COVID-19 scenario, one of the things that, of course, the first things they ask are about the loan provisions that Jackie mentioned and seeing whether or not they qualify for those. One of the second things that they don't think of as much, but really one of the second and most critical things for them is to start considering their insurance options. And so when we're talking to clients about their various options, that is a very critical component of it. And I think the third place we've talked to clients a lot about are just contractual obligations, customer contracts, supply contracts, and things like that, and their ability to excuse performance under those types of contracts. But this insurance piece is something that that clients don't necessarily think about right away, but are really an important component of their response.
Agreed. And going forward, as we'll discuss, it may be difficult to get coverage for any pandemic-related losses, and particularly COVID-19 related losses, meaning on future policies. But for policies that are in place now, or at least were in place when the pandemic hit, the issue is what coverage can we get out of those policies? And then separately, what can we get going forward? And hopefully we'll address both of those in today's presentation. So, let's start perhaps with a little bit of Insurance Coverage 101. For those of you listening in who are not insurance geeks like I am, there's essentially two types of coverage, third party and first party. Third party covers you for claims that are made by third parties against you. They provide a defense and indemnity coverage for those claims. The most obvious one that probably every business, particularly a public-facing business, has is commercial general liability coverage. This covers you if a customer or some other third party makes a claim alleging bodily injury or property damage arising out of an occurrence, which is typically defined as an accident or an exposure to harmful conditions. So the perfect example of this would be, a customer has come into your store and they allege that they were infected by COVID-19 as a result of that interaction and are now suing. It could also be a product liability claim. This is something, if you're now manufacturing air filtration equipment, if you're manufacturing masks, if you're manufacturing any kind of a product that might be used in connection with COVID-19, a claim can be made that you did not properly manufacture it, that you were negligent in your policies and procedures, and this coverage is there to protect you. It doesn't apply unless a claim has been made, although a claim can be not only a lawsuit, it can be a written demand for payment. But unless someone's making a claim, this type of coverage is not going to apply. It's just for claims. I suspect that claims will likely be covered under these policies to the extent there's no virus exclusions, and so that they are likely to be there for you if you are sued.
So for these claims, it seems that one of the things that I would think a plaintiff or a customer would have trouble proving is some sort of causation related issues.
That's correct.
Especially for the virus, it just seems that would be probably the biggest impediment to the use to being able to successfully bring a claim is proving causation.
I completely agree. The caveat to that, though, and the good news for policyholders is that a third-party claimant's inability to prove causation, meaning that they can't prove that they were exposed as a result of interacting with your business, as opposed to getting exposed and infected somewhere else. Whether they can prove that or not is actually should not impact this type of coverage. It will certainly impact the coverage under business interruption. But in this case, you look at initially what are the allegations of the complaint, regardless of whether they can be proved. If there's an allegation of causation, you got to assume it, and there should be a defense available. If at the end of the day the third party cannot prove that the relevant causation, then their claim will fail. So from a coverage standpoint, causation is going to be an issue for the third parties, but not necessarily in third party coverage, although we'll certainly talk about causation as a problem in the first party coverage.
So I think if the client gets a claim, if a third party is bringing a claim, I think the underlying approach should be making a claim for insurance and
absolutely
carrier know and treat it just like any other type of insurable event.
Absolutely. Do not worry. It does not cost anything to make a claim. It's not a big deal in the sense that it's typically just, especially in a third party case, you get a complaint, you get a demand letter. There's usually in your policy an email address that you can send your claim, you can make a claim to, and you send that, or you have your broker do it. It's not a complicated process. And so yes, absolutely, making a claim is key. The other type of third-party coverage I wanted to talk about was D&O. It's not something that people are necessarily focused on right now in the onslaught of issues that have arisen with COVID-19, but I suspect that there's going to be a wave of D&O issues coming down the road. D&O policies or management liability policies cover directors and officers for essentially breaching their duties. Depending on the language of your policy, if you're a private, smaller business, you may have even broader coverage than larger businesses do, that are particularly those that are publicly traded. Essentially, these policies are there to protect against shareholder claims. But imagine now, what you do now could impact your liability going forward on a D&O basis, because if you can't change the policies and procedures you put in place before the outbreak, but you can certainly affect what you do now. And if there's inadequate preparation, inadequate response, failure to properly account for the risk, you can expect down the road a shareholder who's lost value might be looking to recover that value through a D&O claim. And so I think it's the important key here is to make sure that you're taking the appropriate response and appropriate steps that you need to mitigate risk, so that down the road you cannot be accused of having breached any kind of fiduciary duty or obligation to shareholders. The coverage issues here are relatively insignificant in the following sense. Unlike the first party coverage that we'll talk about momentarily, where there are virus exclusions, you're not going to see a virus exclusion in any kind of D&O policy. You will see an exclusion for claims alleging bodily injury. However, because the shareholders or other parties that would be bringing these claims are not the ones that are actually injured, it's very unlikely that this bodily injury exclusion would apply. And as is always the case in D&O claims, there's always a question of, well, was the alleged wrongful conduct committed in the director or officer's capacity as a director or officer? Or was it perhaps in some individual capacity or other capacity? That's an issue that arises in a lot of D&O claims. And it would be dealt with the same way in relation to coronavirus claims. However, at the end of the day, much like the general liability coverage, D&O claims going forward, we might see an exclusion. But for claims that are brought within the current policy period, there is, I believe, a high likelihood that at least the defense will be covered. But again, just keep in mind that what you do now may come back to haunt you later, and as a result, it's very important to take all proper measures to mitigate risk now. Finally, workers' comp employer liability. It's not necessarily a hot topic that's been discussed in the media, but employees that are injured in the scope of their employment are entitled to workers' comp coverage. The problem may be that they were at no greater risk than anyone else in the general public, and so they cannot show that their employment actually put them at greater risk than anyone else in the general public. But if you're a grocery chain, if you had employees that were infected as a result of interaction with customers, if you're a healthcare related business and your employees can definitely show that they were at greater risk for being infected with COVID due to their work, they should get coverage for their lost wages and medical expenses through workers' comp. As the addendum to workers' comp is employer liability. Most workers' comp policies have a Part B, essentially, which is employer liability. It covers claims by workers or employees that aren't covered under the workers' comp laws. So these would be claims that someone was injured, but perhaps they were injured at their place of employment, but for whatever reason, they were not at greater risk. And so perhaps they're not covered under workers' comp. But most businesses do carry employer liability coverage, which would cover that claim. Also claims for additional damages beyond just medical bills and lost work, and claims by family members or estates against an employer for harm done to their family member, claims for loss of consortium, or if someone has passed away, claims by the estate would be covered under an employer liability policy. But here's where the rubber meets the road. First party, this is where the business interruption coverage is going to reside. This is coverage for your, unlike third party, which requires a claim. This is coverage for your individual losses, the loss to your business income. Property, there are different types of coverages, and property policies are sometimes very difficult to for a lay person to even understand, but typically they cover two things: property damage and business interruption. Those are two, or some policies refer to it as time element, or business income coverage. But imagine, it's probably easier to understand if you imagine what your typical property claim would be. A tornado comes through and destroys your business. Obviously, you're covered for the property that was destroyed, but if you're shut down for a certain time, which is typically referred to in these policies as the period of restoration, if you're shut down for a time because you have to rebuild, that loss of business income will be covered under your property policy. You also get coverage for extra expenses that you have to incur to continue to do business because you've suffered this physical property damage. Property policies also include civil authority coverage, which seems to be what, based on the circumstances that we're dealing with the stay-at-home orders, just exactly what the civil authority coverage was intended to cover. It's loss of business income and extra expense because an order of a civil authority has restricted access to your property. That, if you're a restaurant, that clearly has occurred. Now, one of the issues that we'll talk about is whether there's been direct physical loss. But in terms of an order, the stay-at-home orders do seem to qualify. Contingent business interruption is essentially an interruption in your supply chain. So even if you're not shut down, if one of your key vendors or suppliers is shut down because they've suffered some sort of physical damage, then you might get coverage under your contingent business interruption for the loss of business income and extra expense that you have to incur. And then finally, I included leader property because a lot of businesses do have this coverage. The best way to describe this is would be, for example, if you have a motel or a restaurant or right next to Disneyland, and then Disneyland shuts down, even though you haven't suffered any physical loss, clearly you have suffered a loss of business income due to the closure of Disneyland, and that's what this coverage is intended to encompass.
Alex, this type of coverage from a company's standpoint is probably the most important for them to be considering now in terms of making claims for their own damages they've suffered or losses that they've incurred. What are you seeing in terms of businesses having these types of policies? I assume that most businesses do, in fact, have at least some of these, the property damage related policies. But in terms of seeing both having the policy, but also in actual coverage, what has your experience been so far in making claims and filing claims and seeing whether or not there's coverage? I mean, I've had a number of clients who've reached out to their brokers and been told they don't have coverage for COVID-19. And then we've looked into it in a little more detail and found that that may not, in fact, be be true. So I'd be curious to see what you're seeing in terms of coverage for the COVID-19 and related matters.
Well, there are coverage issues that we're going to talk about. Typically, what we're seeing is denials across the board, with some very small exceptions. Some individual businesses may have sublimited coverages for communicable disease. But for the most part, we're seeing insurers take a very hard line. And I think the reason they're taking a very hard line is because of the scope of the loss. When there's a hurricane or a tornado, it may cover a large area, but nevertheless, it's still localized. There is no such thing as an earthquake or a hurricane, a flood that affects the entire country. Not so with a pandemic. Virtually every business has been affected, and every business typically carries property and business interruption coverage. So if you stack up all of those limits, and you'll see that the exposure here is huge.
Yeah.
So as a result, I think insurers are taking a very hard line. In many publications, we're now seeing insurers say things like, well, we have $875 billion in reserves to cover property and business interruption claims. But as you can see, based even on the CARES Act, the loss here is potentially much greater than that. And as a result, insurance companies are pushing back hard. Now, having said that, are they being overly zealous? Yes, of course. Are there coverage issues? Yes. But are there responses to those coverage issues? Yes, there are. And, the problem for policyholders, and I think what insurers might be capitalizing on right now, is that policyholders, particularly small businesses, time is not on their side. They don't have the ability to invest in lawyers and coverage litigation. And so I think insurance companies are really relying on that to a large extent. But we are seeing litigation start popping up all over the country. And the issues are, as this slide indicates, there's about 4 different issues that we're typically seeing, but they really come down to, is there direct physical loss or damage, and is there an applicable exclusion? All property policies require some sort of physical loss or damage to property to trigger coverage. And as you can see, it's easy to see what the physical loss or damage is if there's a hurricane, if there's a tornado, if there's a fire. But when you're talking about a virus and a pandemic and a disease, it's a little less clear. And some of the case law in this area it may depend ultimately on state law. Minnesota law happens to be pretty good in that loss of use of property is at least relevant to the scope of the damages. But the burden of proof is ultimately on the policyholder to show that there's been some physical loss or damage to property. And so you can see how the insurers are asking, well, do you have proof that anyone infected with COVID-19 was at your place of business or that they were infected there? If not, then the fact that you've been closed down it just isn't good enough. There are responses to that. I think the most obvious response is, well, wait a minute. From a statistical standpoint, depending on where your business is, it stands to reason that, yes, somebody probably was infected. For the civil authority coverage, you don't necessarily have to show that there's been physical damage to your property. It can be physical damage to any property. And clearly, physical damage to property has occurred in that the virus has contaminated the air, it has contaminated surfaces, it has caused widespread contamination. And the fact that we can't test for it doesn't mean it doesn't exist. But the lack of testing is a barrier to a certain extent. But if you get a denial from your carrier based on direct physical loss or damage, there are arguments to make in response. The other issue is exclusions. Some policies have just pollution exclusions that will include virus in the definition of pollutant. Other policies will not include virus, but they will include contaminants. And so it's a question about whether a virus is a contaminant. I think, frankly, if you have one of those policies, you're in pretty good shape, because I think there's pretty good arguments that it's not at all clear that a virus is a contaminant in the sense of, as one would expect a pollutant to be a contaminant. And there are arguments that that language is ambiguous and should be interpreted in favor of coverage. Some coverage is also offered by pollution liability policies, that some of those policies, if viruses are excluded from your property policy, you may have a separate pollution policy that includes virus contamination. And many of those policies also have business interruption provisions. But the virus exclusion is the biggest problem. This is where, if you have a virus exclusion that is very broadly worded to include any kind of loss or damage, direct, indirect, resulting from a virus, those are the most challenging. Are there arguments? Yes, there are. For example, you can see there under virus exclusion, I gave you some sample language where it says we will not pay loss or damage caused by or resulting from any virus or other microorganism. And I think there are good scientific arguments that a virus, despite what lay people might think, is not a microorganism. It's not an organism at all. It's not alive. It's not organic, and therefore is not a microorganism in the strict sense of the word. It remains to be seen how these arguments fare in the courts, and again, it may depend on the particular state that you're in, because insurance is a state-by-state analysis. But it's not a foregone conclusion that even if you have a virus exclusion, you're not covered. And then finally, I just wanted to add suspension of operations. Some policies for the business interruption component discuss total suspension of operations as opposed to slowdowns or partial suspension of operations. So, in the restaurant context, obviously restaurants that are doing takeout and delivery are clearly hurting because their business has slowed down, but they're not completely shut down. So the language of the policy on suspension may be important as well. So here we get to the last issue I wanted to discuss today, which was reps and warranties coverage. As you know, if you've done any deals recently, reps and warranties insurance has become ubiquitous in the M&A context. And basically, to those of you who aren't familiar with it, it covers the buyer or seller, as the case may be, for breaches of representations and warranties in an M&A purchase agreement. We have seen rep and warranty insurance, we're expecting and we're already seeing exclusions for loss arising out of this outbreak. These policies, though, are manuscripted in the sense that you can negotiate the terms. They are not at all pre-printed forms like you might see in your home insurance or your auto policy or even your general liability policy. Negotiation is going to be key, and so when you see these exclusions pop up, it's going to have to be negotiated heavily to make sure that it doesn't just encompass the entire business. We're also going to see in the underwriting and diligence process, insurers highly focused on the issue of how the target is dealing with COVID-19. They want to know, are there supply chain issues? You have potential claims coming down the road because your workforce might have been exposed, or customer demand, etc. There's going to be a highly increased focus on COVID-19 related issues in the diligence process. Whether that's going to result in less coverage, more exclusions, remains to be seen, although I suspect that it will, and that this is going to be a bone of contention in the underwriting and diligence process with the carriers. It's very early. Sorry, Mark. I was just going to add, it's very early in the process.
Yeah.
So it, again, this is all unfolding in real time. So we don't know exactly how it will all pan out. But the point to take away is that you need to negotiate this language and make sure that you're comfortable, and have your counsel make sure that they're comfortable with any kind of language or exclusionary provisions related to COVID-19.
And to sort of echo your point about the increase in the due diligence process and the underwriting process, I've been involved in a recent call that was just on COVID-19 underwriting call, and usually they get picked up in a variety of or those types of calls get picked up. There are a variety of topics that get picked up in it, and this one was devoted solely to COVID-19. So I think I think we've reached the end of our presentation. Want to turn it back over to Craig, and if there are questions, happy to jump in and answer any of those. But otherwise, Craig, I'll turn it back over to you.
Great presentation, both you guys and Jackie. Appreciate all the insights that you provided. Looking at chat, no questions. Kind of the last call. Okay, here we go. DNO, what are good ways to check you're doing the right things? Can you recommend a checklist?
And I think Alex we may have lost Alex's connection here. I haven't seen any checklists. I can certainly circle up with her to see if she has seen any checklists. I think it would be the same as dealing with any other crisis at the board level, making sure that you look at your policies and procedures that you have in place, checking your insurance coverage for things like COVID-19 and other potential issues that are coming up, and then looking, as you develop the policies, always keeping in mind, and I think many companies are doing this already, but always keeping in mind the health and well-being of the employees and the customers, and doing what employers need to do to make sure that the employees and the customers stay as healthy as possible. I think those are some of the key things, but I can certainly circle up with Alex and see if she has anything more specific on that.
Okay, go ahead, Nick. Nikki, why don't you update it with the next events? Okay, so we have a happy hour on Thursday, and we have another lunch and learn with Redpath and Frederickson Byron next Tuesday. Looking forward to having everybody there. Thank you.
Thank you, Craig. Thank you, Alex. Thank you, Mark, Jackie. That was fantastic. And for everybody on the call, we will have this audio clip posted on the ACG website. We'll share the presentations. And if you need questions answered, feel free to reach out to our presenters directly. And we'll see you Thursday for our member-only happy hour at 4:30, Friday's Woodchuck at 7:30 a.m. And next week, now I got my funding, what do I do next? And distressed M&A. So we look forward to seeing you again soon. Until then, stay safe, stay well, and we'll see you again soon. Thank you.
Thanks.